Well, hello, Wealth Press subscribers. My name is Roger Scott, and this is our midweek roundtable. I'd like to welcome you, and Jeff Zananeri, our usual troublemaker, and our co-host is here. And folks, this is your chance to really get inside our minds. We don't pre-script these. We don't talk about what we're going to talk about. As a matter of fact, we were talking about the pros and cons of Games of Thrones versus mafia movies a few minutes ago. So we did not talk about the markets at all today. This is going to be a very, very fresh and a very, very interesting discussion. And by the way, I'll say this now, and I'll say this before we end. For those of you who want to reach out to myself or Jeff, my email address is support@marketgeeks.com. Jeff's email is jeff@joyofthetrade.com. We'll take the good, we'll take the bad, and we'll take the ugly. Jeff, welcome. How are you doing today?
I'm great. Thanks for having me, Roger.
Absolutely. So, boy, what a week! What a week! Let's start off with the pink elephant in the room. Why don't you summarize and kind of give everyone your opinion of and kind of put an end to our discussion of the small caps short squeeze. What's your view this week on it?
I think it's going to kind of fade into the sunset as people realize that it's not an actual way to make money in life, unless you're one of the people that figured out how to orchestrate it from the beginning, to whom, I do a little chapeau for just the ingenuity that was involved with it. I'm not sure it was legal. I'm not sure the SEC is going to think it was legal either, but the only people that are going to have turned out to turn a profit in it are going to be the people that orchestrated what happened, which for me was incredibly clever, incredibly sophisticated, reeked of pros. They knew how the market was set up. And this is a big thing. Everybody's now an expert on shorts, though I can count on one hand or two hands the people that I know that have actually ever shorted a stock. And there's a difference between having big short interest in a stock and having a concentrated short interest in the stock. And only insiders know how concentrated a short position is. What I mean by concentrated is how few people are short the stock. So if you have 100,000 people short and it's 100%, it's different than having 3 people short, because that's how you can generate a squeeze. That's how you generate a real squeeze, because you know how they're positioned. You know the size of their position. You know the size of the position relative to their overall portfolio, which really matters, because you only get bought in, which means that your prime broker makes you buy back a short if you go below your margin. So you have to maintain a certain amount of capital to float all your positions. And if you go below that margin requirement, then they buy you in on your shorts first before they even make you sell your stocks. It's the law. And so, the fact that these guys knew that GameStop was concentrated the way it was, it reeks of some coordination with people on the inside, and not just from the hedge fund world, but inside prime brokers, investment banks. So I think it's going to unravel, and I think it's going to come to light, and it's going to be one of these stinky things that people are like, ooh, those guys played all these people like that. They use social media to get people to conduct this experiment and this mastermind deviant trade. So because of the fact that most people are going to lose their butts in it, I don't think it's going to be a process that continues over and over. However, I'm more cautious about shorting in general, based on public sentiment about shorting, et cetera, et cetera. So just something to think about.
Yeah, I agree with you. And by the way, I completely agree with you 100%. I also believe it's a coordinated effort. I think if this was just a typical, the kind of short squeeze we'd see, it would last maybe a couple hours. The price of the stock would run up maybe 10%. And, the usual thing where nobody really pays much attention, or it's a one-day thing. Yeah. It takes a lot more coordination to run a stock up for several days and to mess with the three of the largest hedge funds.
These guys were buying these options from months ago. They were buying them when the stocks were trading. GameStop was trading $10 a share. They were buying these options. So it's they didn't just come up with this strategy. They've been plotting this thing for a little while now.
Yeah, I agree with you, and I would also caution traders to be very, very cautious trading short. If you want to buy put, I totally get it, but be careful.
Yeah, that's the way to play.
Be careful. Yeah. And interestingly enough, I called out several other stocks that followed suit And I'm going to tell you, a lot of them are, well, not a lot of them, all of them are doing exactly what GameStop is doing right now, going south. And I think there's going to be a lot more, there's going to be a lot more downside to go. I don't think this is going to be a one-time thing. And I also think about the amount of investigation that the SEC has to do right now. It's going to take some time. There's going to be some IP addresses, this, that, but eventually they're going to be able to lay this out like an airplane crash and put it all together completely.
This is old news, man. Like, you know how many times it always happens in the options, because that's like that's what people trying to, greed is a big factor, right? And so you get a lot more bang for your buck in the options market, which is good for us. But when we see abnormal moves, we're always like, that's an insider, right? Like, you start to think like, this guy knows what's going to happen. You'll see like this big accumulation in some option, and then a takeover will happen. And then invariably they go back and they link, and some guy talked to a guy at a golf course in Jersey or Long Island or Westchester or something. And he's like, hey, you're not correlated to this industry at all. Why don't you set up an account? We'll go halves. The guy sets up an account, and they always find it. They always do, but it takes time. It takes time.
Yes. Yes. Yes.
But the tentacles get people caught. It's the tentacles that get people caught.
Big time. And I think one of the factors that and I don't want to stay with this issue to death. I'll move on to something right now, but I just wanted to let you know that I think the fact that the SEC made a big stink last week, I think, or over the weekend, I think that also scared off some people and made them realize that, hey, maybe I should just, like you said, like the example you gave last week. If somebody's at a restaurant and you're at a bar, and you're looking at the bar and somebody there is doing drugs, you're probably going to not want to be around those people.
Yeah, because that's not what you're there for. You're there to have a drink like a normal person and enjoy, real life, within the confines of like legality, right?
Right. So last week, I think it was more a matter of greed and intrigue. And this week, it's more of a matter of fear. And we all know that fear is a greater emotion than all of,
what's interesting to me is that there's been an incredibly tight correlation between an inverse movement in the meme stocks and the broader market. So last week when the memification was happening and the YOLO idiots were watching their stocks triple for half an hour, the stock market was tanking. We had our worst week in months last week. But then this week, normalcy started to come back into play. Those stocks started to tank. People ran for the hills that were the operators, and the broader markets recovered really nicely to begin February. We're seeing like huge, biggest first 2-day buy since November. I track the institutional flows for the first couple of days, and they're massive. There's massive flows coming back into the stock. So people like you and I that don't get caught up in FOMO and don't chase the latest fad and just do what we do, like the balls come back to us. So in the meantime, there were like nice trades to put on last week. And the stocks are like really doing well. A lot of these stocks are really doing well right now. A lot of these sectors that we've been optimistic on are starting to pay off. So the distraction starts to subside, and business as usual always comes back. And it's a real let me just say one last thing. Please. It's a real learning lesson to not get off your game, to not get moved off your ball, to be disciplined and stay consistent with what you're doing, rather than to get dragged in from FOMO for somebody else.
My question to you is this: what did you, or what are you making of the fact that the Dow is penetrating, or starting to, or it looked like it was up to about 2 days ago? It looked like it was hitting the 50-day moving average. Did that cause you to pause a little bit on blue chips?
Yeah, I mean, I still think that there's going to be a lot of fake out breakouts, and there's a lot of volatility in this market, and there's like this. This is the thing, Roger. We're in earnings season right now, and a lot of the earnings have been good. So what do you do if you're a trader, right? I'm pessimistic because I've been a little bit bearish and I've been a little bit cautious. So last week didn't entirely catch me off sides. You and I is something we've looked at for a long time. Is this just like constantly elevating VIX with the market still near all-time highs? Having a VIX north of 20 with the market near all-time highs is a head scratcher. It's a bit of a red flag, right? But it's indicative of the fact that we're just going to have these big gyrations that are going to shake people out, and then you go back up, and then you shake people out. Invariably, that leads to like more bearishness than bullishness, but it can stay like that for a little period of time where you get like these 5%ers every week, and people are just like, what do we do? That's awesome for people like us because we time those things. But for general population and people that are just like looking to buy a stock and sit in it for a few years, it can be awfully intimidating and confusing because they have a propensity to buy after this 5% pop, start buying now, and then it subsides again, and then they're down, and they're on the water almost instantaneously, putting on their investment, and so it's just a hard tape to be an investor in because of that. Is what I think it's going to be, and then it's going to be
a trader's market. It's definitely
a trader's market. It's like it's a super trader's market, and it's like I think that's going to be the name of the game of 2021. You have to be nimble. You can't rest on your laurels, and you can't just like, just buy whenever indiscriminately.
How do you? Let me ask you this: how are you reconciling in your mind and in your trading? And what would you tell people? A lot of stocks in regards to this. A lot of stocks that were really skyrocketing around the summertime, not necessarily the first stage of the pandemic, but the stay-at-home stocks. A lot of them look like they peaked out in August and September, and a lot of them, like I was looking at Humana this morning. I was looking at, I forgot the name. It's called Brown and Dwight. The company that makes Arm & Hammer products.
Yeah.
I may have the name wrong. So if I do, I apologize, but I think it's called Brown and Dwight, something Dwight. And I was looking at Humana, and both of those stocks, as you know, they were, summer, they were making all highs. Right now, they just broke the 200-day moving average in the last few days. And that's healthcare. Do you think the market is clearly
Pfizer is deeply off of its high still? I mean, yeah.
What do you make of that? How do you consolidate the fact that a lot of the stay-at-home stocks are eating it right now, but at the same time,
they're not all though. I mean,
no, true.
Stocks like that, people have been using Venmo a lot, right? So it depends.
Not all, but that's a good point. Not all, but how do you consolidate in your head and in trading action that the actual pandemic conditions may be sustained for quite some time, but the market is looking so far into the future to discount all of these stocks that were so hot in the summer. I'm just having a little trouble with that personally. What about you?
I know I am too. I can't say anything more than I can't assign it to anything more than they just ran so damn hot. Like those stocks ripped so hard off the bottom, right? And I don't think people anticipated that the economic recovery, and I'm going to be included in that. I still think this is the part that I'm having a hard time reconciling, Roger. We're having a pretty buoyant economic recovery, both in earnings, both in people getting back to work, but the reopening is worse than I thought it would be. So I've been right about the reopening, but the economic activity, we have figured out a way as a society to reinvent the wheel on how we live our lives in a more homebound fashion, but we're still spending money and having stuff delivered, et cetera, et cetera. So I guess it's it's like two things have happened. I guess I got part of it right, but part of it wrong, but it's starting, that's the beauty of being a trader is you have to examine yourself all the time stringently. And so I think the reopen we've been right about. You and I've been nailing that. People aren't rushing to go back to the office. We talk about your office and you guys are just not going to have everybody back. And that makes a total sense to me. And I think that's the way across the world. So I think a lot of these online services like Zoom, et cetera, they're going to have a purpose in life no matter what. They're going to have a purpose. And so there's no discounting that. But we have seen parts of the world like Asia, like China's rebounded so hard. They're rebounding so hard in some places. And in parts of the US that are kind of more open, it's rebounding really well and people are getting back to work very quickly. So it's kind of like a tale of both of those things being right, if you ask me.
No, I think you hit on something early on when I asked you the question, and I think there's two ways I'm reconciling it in my head, and you perfectly hit the first part, valuations. I think that some of these companies, the carrot just got too fat, because you always have to have that carrot in front, and the carrot just got too fat. I'm seeing it on Salesforce. I'm seeing it on some cloud stocks where the sizzle just got too hot. And I mean, okay, Zoom is okay, fine. There's no question that 99% of the people in this world now know what Zoom is. Right. Can Zoom continue to generate the type of, is it going to be the next Tesla? I don't think so. So So and I think you're right. I think that's part of it. But I also think there's another part of it, and I'm going to tell you what I think it is. What I'm doing is I'm kind of separating the reaction that we had from the COVID. I think you're going to find this interesting.
Yeah.
I'm dividing the reaction that I'm taking the entire stay-at-home run-up that we had.
Yeah.
And what I'm doing is I'm kind of looking at it in two different, I'm separating into two. The first part is the emergency stocks, the toilet paper, oh my God, what are we going to do? The world's coming to an end. Panic stocks.
Yeah.
And here's what I'm seeing. I'm seeing a lot more downside on those panic stocks. Those were the first parts to rally. And then more of the other stocks, the hey, how are we going to take advantage of this economy? Stocks came around. So the first part was, the world's coming apart, toilet paper, Clorox, bleach, blah, blah, blah.
Right.
And then as we got into it deeper, it was kind of more of like people started thinking like, okay, Zoom. And so I'm seeing, I believe that the world, even if God forbid, if tomorrow Biden comes up and says, guys, we found out, Fauci comes around and says, we found out that I'm making this up. I'm just, just to be clear,
go.
This is just for purposes of illustration.
Yeah.
I don't want anyone thinking that this is actually happening. So if Fauci comes out and says, for example, hey guys, we just got data and these new strains that we are seeing, they are, the meds that we have they're like 10% effective and we're back to square one. If that was to happen, I don't think that's the case at all. I don't think we're anywhere near.
I don't either, but you never know this world. You never know.
We've seen bigger surprises have happened in 2020. It has. So let's say it happens. Let's say another variant comes out, and I don't believe the world will go back to that first stage of panic, because while COVID is new and while COVID is that we've been there before. It's kind of like a second earthquake. Yeah. I don't think you're going to have lines of people buying toilet paper because they already know that, we've been there, done that. Yeah. So I think that's part of it. I think that it's there. What I'm trying to say is, I think there were different qualities to this run up that we had in the market. And I think some of it was done based on just pure fear and panic. And some of it was done based on the new reality. And I think we have to kind of separate. I think if we separate those.
Listen, cloud computing is getting much bigger. People working from home. They don't have, if you work for a big company, and you work at the office, they have servers a lot of times. So you don't personally need cloud to store all your stuff, right? But when you have everybody working from all over, it's much easier to access files and share through a cloud. So, that is an aspect of the new reality that's doing really well, that I think is going to continue to do really well. Semiconductors are going to continue to do really well. Like those aspects of the technologification of life is going to continue to do really well. Delivery services going to do really well. So I'm thinking of things like, I don't want to be in a situation where I have to get the most obvious stuff. To me is the best stuff. Like we've talked about cannabis. Cannabis has been on fire. It's been literally one of the best sectors. People are like, why do you like cannabis? I'm like, it's an obvious one. The Democrats came in, they want to federalize it. These guys haven't had banking. It tanked. The sector's coming to their 2.0. It doesn't have anything to do with the reopen. It doesn't have anything to do with COVID. I love that.
Well, actually, it does. The the demand has skyrocketed as well. It's almost got better. Yeah.
But the secular shift into cannabis and the federal legalization of it doesn't have anything to do with whether a new strain comes out or not. That doesn't.
This was, by the way, what you're talking about right now was the last thing my wife and I were talking about before we went to bed last night. Exactly that. Very, very true. No, it's a no-brainer. The fact that it's time.
Clean energy,
lithium, clean energy, basic materials, things like that. Yes,
it's happening. Workhorse was the stock of the month last month. in January for the monthly money flows. I know you like that one. We've done a thing together with that. And Workhorse was an example we used historically, and then it came back again. And it's like, for me, it's an obvious case. People are accumulating it on Wall Street because this is a company that they're going to turn, the kingmakers are going to turn into a behemoth. It's an American company. They create electric vehicles, manufacture them in the United States. They're an American company. And Biden came out at the end of last month saying, we have to overhaul our entire United States fleet of vans and trucks.
He sure did.
With electric vehicles. There's like one company in the world that can do that, could possibly do that.
Yes.
What do you want? I mean, what do you want? This is obvious stuff. Like, I'm not a superhero. So when I saw an accumulation and these things have like non-COVID things, like I don't want to have to guess the future. I want to pay attention to what's happening right now.
Right.
It's much easier to do that than to guess what July is going to look like, I think.
I agree with you. And I'm in the exact, and every sector, the semiconductors, the clouds, the clean energy, the pot stocks, and things surrounding the pot, like the things that are, the shovels, the gold in the shovel play, basic materials like lithium, and so forth. Lumber's going crazy too.
Copper, you nailed copper.
Copper,
you nailed it. These miners,
last question for you before I let you go today. The bond market, specifically the long bond market. What do you think? I mean, short term, short bonds, we know nothing's going to happen. There's no excitement there. What about the long bonds? Are we going to stay range bound, or are we going to drop lower?
We're going to drop lower. They're going to introduce 50-year bonds, 100-year bonds. You got $17 trillion of negative yielding bonds in the world. $17 trillion negative. So you can't have this discrepancy between what's getting yielded in the United States, what gets yielded in corporates, and then have Germany, charging 30 basis points to take your money from you. You pay them for them to take your money. And so as long as that phenomenon exists in the world, which I think it will, because a lot of the world is not the United States and is not China and is not Korea. A lot of the world is stuck in its own malaise. All they have is unemployment. All they have is these shutdowns. They don't have the big technology manufacturing. They don't have the creative class at the United States. What they have is cheap money and socialism to keep the game going. And so as long as you need those two things going in a lot of the world, I don't see a situation how you're going to get a rip. I'm more concerned with like short-term, short duration yields going high because people get stressed in overnight lending facilities. That's a problem when you get, because then you'll feel it in the stock market right away. Margin will get hit. People won't be able to borrow as much to buy stocks, et cetera, et cetera. They'll have to shrink their books, banks, et cetera.
Right. And
that's kind of what happened with Robinhood. That's what people don't understand. Robinhood didn't stop people from buying GME because they didn't want people to make money in GME. They stopped it because they're the ones on the hook for the money in GME stock as a counterparty. And they didn't have enough. They didn't have enough money in their own bank account.
No, they did not. No, that actually
to settle that trade.
Right. That's just irresponsibility. That's craziness. But it is what it is.
It is what it is.
Well, Jeff, I think I've got enough information from you today. This was an amazing session. I love our sessions because they're just so unscripted and they're so live and they're so raw. And again, folks, there's no agenda here. We just want you guys to kind of get inside our mind and start seeing how we think about the markets. And again, we're not, as Jeff said, we're not, we don't have any inside information. We're literally picking the low-hanging fruits, and that's the best way to be because they have the best reward to the lowest risk level.
And do stuff that's worked. Like do stuff that you've made money on, and then do it again, and then do it again. Do stuff that works. Don't try to reinvent the wheel. Don't try to predict the future. Keep it
and stay away from trouble. Don't go to bars where people are doing crack, as Jeff said. That sounds so
literally awful. on the trading desks that I've always worked on. A stock would get assigned. That's a crack stock. We would literally say that has just become, and like, it's not just GME. This has happened at different stocks, that irrational wild moves. And people say, you might not want to put size on in that. That's a crack stock. That's become a crack stock. And it's literally like, you don't want to be with the crack smokers. It's just like rule of thumb.
So folks, stay out of trouble. And if you really want to get in on it, buy a put after the run up is over. You'll have a much higher risk to reward, and you'll have a good volatility going in your direction and all of that stuff.
Yeah, wait till that vol comes. It's so high. Right. I was looking at these things, and they're trading like 50% out of the money at like 500 implied volatility. The problem is on the puts right now, the way it is right now, and it's going to loosen up, is that the stock loan is like 50% interest a year and higher for a lot of these names. To borrow these stocks to short them, if you're allowed, if you're like a real player, is going to cost, you're going to have to make north of 50% to break even in a year on the trade. And so they pass that pricing through to the options.
Right. Which is it's
too expensive.
It's insanity. Yeah. You don't go to Beverly Hills when you can go to, you bargain basement store in a couple of weeks. And I really mean that.
I'm with you, Roger.
Jeff, it was wonderful having you here. Folks, if you want to reach out to Jeff, you have a question for him, if you have a comment, if you have a feedback, it's jeff@joyofthetrade.com. Anything, good, bad, ugly, we'll take it. Yeah. If you want to reach me for any reason at all, please do. I welcome emails, support@marketgeeks.com. That email will be checked by me very, very quickly. Thank you all, and we will see you next week. Jeff, thank you once again for being here. It was a great conversation.
LFG, let's go.
Bye, guys. Bye, everyone. Bye-bye.